All right. Well, thank you. And wow, great presentations here today. Really appreciate you guys at Traders Talk Live having me here. It's just a wonderful event, and to bring so many excellent traders together, so many great concepts and ideas. It's just amazing. You know, back when I started out, we used to have to fly around the country, around the world to get access to multiple excellent trading opportunities like this. And now to be able to do it with this technology, it's just crazy, crazy, crazy. Of course, now I'm showing my age. So anyway, I've been trading for 50 years. So yeah, I've been around the block a few times. And when I was born, we didn't have even color TV. We just had black and white TV. So now, you know, I'm an old man, born back in the days of yore. So I've seen a lot of things change, and just so cool to see the kind of technology that right line trading is providing, and the others. All right, so today we're going to talk about, during my 45 minutes here, Fibonacci, and we're going to go a little bit beyond probably what you have learned before. So I know we have people at all different levels of trading, so we'll start with some of the basics, and then we're going to get into some of the more advanced stuff and how to use it as part of a complete trading methodology. So let's jump right into it. There we go. All right, so there are various types of market geometry that can be used in trading, and Fibonacci is just one of them. So you can use Gartley patterns, even astrology, squaring your charts like Gann did, and all that has some pretty cool applications. In this presentation today, since obviously we only have a small amount of time, we're going to just focus on the following numbers and their extensions with regard to Fibonacci. Now, these are actually not even the Fibonacci numbers. The Fibonacci sequence, which I won't really go into detail today because it's just, you know, it's the math of it and so forth. It still has some significance, but I've got it in my header here. That's the Fibonacci sequence. Those are the actual Fibonacci numbers. And then in most people's trading, they use Fibonacci ratios, and these ratios are derived by subtracting one of these numbers in the sequence from another. So bottom line is, here are the numbers that I use in my trading. 0 to 100. That usually covers the span of an impulse move. And then 23.6, 38.2, 50, 61.8, 76.4, which is really just the inverse of 23.6, so it's not a true Fibonacci number, and neither is 50, by the way, and 100. So these are the ratios. If you want to jot those down real quick, actually you'll see those numbers again, so you don't have to jot them down. We'll have them in future charts, such as this one right here. So let's talk about actual application. Let's jump right into application. So the most common use of Fibonacci is probably with retracements. So as I mentioned, we've got an impulse move from that high to this low. Alrighty, so looking at that, then we draw our Fibonacci retracement lines, and here's your percentages again. So this 0 means that from this high to this low, once we've gotten down here, the market has moved back up or retraced 0%. Then if it goes up to this level, it is retraced 23.6%. And 38, 50, 62, 76, you get it. All right. So Fibonacci retracements are often used, they have several different uses, but they are often used to find levels where the market will continue in the direction of the impulse move, looking for a retracement back. But even a bigger picture than that is they are used for support and resistance levels. So you can also use them for consolidation patterns, reversal patterns, triangles, pretty much anything. But the bottom line is they are focused on the y-axis, so price, support, and resistance levels. So as you can see here, our next impulse move is back to 50%, half of the way between 0 and 100, so back half the way from where we started. Alrighty, and that's a very common one. And then as it comes back down, it goes down to what, 23.6. The next high is found at 61.8, Next low is found at 23.6 again, back up to 61.8. So these levels really do work. You really do find that these levels work very, very well, and I do highly recommend that you put them on your charts. Now, the next technique is Fibonacci Extensions. So rather than, well, let me point out, so here we have an impulse move from a high to a low, just like we did before. But now, once we get to this low, instead of looking for levels between here and here, what we want to do is find support resistance levels beyond that low. Now, this technique, that's why it's called extensions. Beyond this low, rather than between that high and low, if the market's going to go further, where do we expect it to go? So this especially is helpful in looking for profit targets. And it doubly is helpful when you are in uncharted territory. Oh, that actually is literally true, isn't it? Uncharted territory. Kind of punny there. So let's say that you're in a market. We could actually, it'd be a good idea for me to next time flip this around, and you're trading a stock that is at all-time new highs. Stock's never had this price level before, and then it keeps going higher. Well, now we have no previous history of highs to use for resistance levels, for profit targets. So how do we determine what profit targets we could use? Well, Fibonacci extensions would be a great way to do it. That would be an excellent tool for that situation. So what we do, this is a three-point drawing tool now. So you go from this high to this low, click, and then you go to this high, and then bam, it plots these levels below that high. So it's kind of like the ABC pattern. And then it plots them after the 3 points. So now we use the same ratios though. So the ratios are the same, 23, 38, 61, right? You can put your 50 in there if you want to, and 100. So 100, what that means is that the move from this high to that low is the same as from that high to that low. It's 100% of the same range. And always put that one on. Always use that. That is called a measured move. And many people are very aware of that. They're watching that level. Measured moves are very popular, very well known. And so you should always have that on your charts as a target, as a potential target. So again, does it go straight there? No, the market's not quite that accommodating, not quite that simple. So what does it do? Well, it goes down to 76.4. Then it retraces back up to 38.2, and then it gets down to 100. And that's kind of normal. I mean, sometimes the market will just go slice right through, but you know, the market doesn't work on just Fibonacci numbers. It works on all kinds of things like news and rumor and gossip and, you know, how people are feeling that day and economics and politics and all sorts of things. So these are, again, potential support resistance levels. And for example, let's look at this. Actually, this is a very important point. So yes, it does get back up to 23 and back down to 76. But in between there, and this is really important, we'll come back to this later because this is a huge point. So it gets down to 100 now. As it goes back up, does it stop at 76? No. Doesn't even give it the time of day. It's like a girl you like who won't give you the time of day, doesn't even know you exist. Does it stop at 62? 61.8 golden ratio? Nope. Again, doesn't even hesitate there. We don't even put a doji bar, nothing. Again, it's like it doesn't even exist. Does it stop here at 38? Nope, nothing. So this begs the question, well, how do we determine which of these levels are going to hold to the market this time? This time being whenever you're trading, right? Okay, we will get to that. That is a very, very important question. And the point is you cannot trade Fibonacci levels by themselves. They're one piece of evidence in the trading puzzle. They are one part of trading. They're a very important part. They work, but again, did it work this time? No. Did it work that time? No. Did it work that time? No. Did it work that time? Yes. So the key is, when will it work? All right, we'll come back to that. Just want to plant that seed, so put a pin in that, and we'll come back and solve that problem for you. All right, so those are the two, I would say, the most commonly used. Now, those two commonly used techniques you can combine. And then we get what we call Fibonacci clusters. You can also create Fibonacci clusters by using Fibonacci levels off of different swing highs and lows, and that's often used, especially using them off of different time intervals, and that's fine. So Fibonacci clusters. All right, so here we've got a major low to a major high, and you can see here we have our Fibonacci retracement levels as it comes down. Then I also said, you know what, but again, as we talked about, it doesn't go straight up there, right? It meanders. So it goes up here, goes down here, and then it gets up here. So during this kind of jigsaw wiggly move, we can also add our Fibonacci extensions. And so now we use our 3-point extension tool from that low to that high to that low. And then it plots these levels above. And those numbers are right here in this column, if you will. And then we look for, okay, where do these lines kind of congest? Where do we find clusters between the retracements and the extensions? And those are going to be a little stronger support resistance levels. And there's a reason for that, by the way. It's not just because there's two lines on your chart, all right? The lines on your chart mean diddly. The lines on the chart are there because they represent something that's going on behind the scenes in the marketplace, at the exchanges, and throughout the world, the global marketplace. And here's what's happening. What's happening with clusters, and the reason that clusters work, is pretty much based on mass psychology. The markets are a huge auction place, and it's people in the computers they programmed who are trading these things, right? So there will be some people who will be looking at the Fibonacci retracements, these levels. And then there's going to be another group of people, probably a smaller group of people, who will be looking at the Fibonacci extensions. So think about that. Now you've got two groups of people. When you get a cluster, you've got more people in the marketplace who are seeing that level and responding to it because they're concerned about, well, let's see, am I overextended in this move? Oops, here's a support level, and maybe I should put my trailing stop here, or maybe I should take profits at this level, or maybe I should buy off of this level. So you've got more people responding to this level in one of those ways. And the more people that are doing it, the more likely the overall market is to respond to it. So here we've got a cluster of the 76 and the 38 here. And sure enough, that's where the market retraces to and goes up. And then up here between 100 and 23.6, it just kind of congests. And the market just kind of says, okay, well, we're not quite sure what to do, but that is at the level where now we are stopping and not going up or down. And that, by the way, is another thing that support resistance levels can do. Support resistance levels don't just provide levels where the market puts in highs or lows. Most of the time people think of it that way, and that's true. But another thing it can do is just be a place where the market kind of settles down for a while as people are digesting information, making decisions, and right now that is what the overall market is considering the fair value. That's what it's valuing it at, and sentiment has not changed, so people are just kind of waiting for something, somebody, something to happen to change that valuation. All right, now let's get into some of the cool stuff. Not that that's not cool, but this is a little extra cool because not many people use it. And as you know, to be successful in trading, you need an edge. We want an edge over other traders. We want to see things on our chart that the guy on the other side of our trade doesn't see. That gives you what I like to call an invisible edge. Would you like an invisible edge? All right, I'm going to give you one right now. So this one is called Fibonacci time extensions. So we saw Fibonacci price extensions, and what we looked at there, again, was based on the y-axis, the price axis, right? Here's the deal. A chart is a two-dimensional object. So we've got price here, and that's all great, and yep, you better learn how to trade price. But then the other axis on the chart is time. And that's it. We've got time and price, Y and X axes. And very few people focus on the X axis, on time. And yet, when you think about it, that's 50% of the information on the chart. That's 1/2 of the graph. And W.D. Gann, he said between the two, time is actually more important than price. I'm not sure if that's necessarily true. I just think they're both important. I do like what he said about trading being about the confluence of time and price. When time and price come together, that's when you trade. And that is what we're talking about here now. So instead of just using price, let's look at how do we read the x-axis or the time axis. And we can do that with Fibonacci too. I'm going to change my color of my pen here real quick. We'll make it a little darker blue. All right, so here's how we do this. Here's how we draw it. These are all drawing tools, by the way. They're not technically indicators. They're drawing tools. So in this is NinjaTrader. In NinjaTrader, you'll find it right here. For whatever trading platform you're using, just ask your support team of your trading platform, and they'll show you where to find your drawing tools if you don't know already. So what we do is, again, we look for an impulse move. So from that low to that high is where we drew the impulse move. So again, you see 0. I kind of covered it up there. And there's your 100. All right, so that's the impulse move. And I started my drawing tool from there, and I stopped it from there. Now, again, as with extensions, it's going to give you levels beyond where you stopped plotting the tool, into the future. Extensions are about the future. And that's pretty helpful since that's what we're trading, right? Anybody can look at a historic chart. It's all, you know, what they say, hindsight's 20/20. That's it. Hindsight's 20/20. So that's great. Not hard to be an analyst. A lot harder to be a trader because we're trading the future, and that's where extensions come in. So when do we expect this market to put in a higher low? That is the question. The pregunta, the Fragen. See, I'm trilingual with the word question. So this is one of the answers to that question. So we get into our 123. Now see, it's drawing vertical lines instead of horizontal lines because it's measuring time. And so here we say, oh, there we go, 123.6 extension. That's when we expect a low to be put in, and bada bing, bada boom, or a shift in the market, I should say, because it can be a high or a low. Again, you've got to use this with other things, and we'll get into that here in just a moment. But we're looking for a shift, the market shift. And sure enough, we get it. Boom. 136, I'm sorry, 138. Again, another low. 150, another high. 161.8, another high. Now, let me point out something here that is very important because we've got to be very realistic. And so I'm actually going to change colors to point this out. Whoops, so I guess I don't have to now. Okay. Notice that it did not catch this high and it did not catch that low. There's no Fibonacci time extensions that caught that high and low. So in real life, these time extensions do not catch every single high and low. They will mark some of them. They will identify some of those shifts, but not all of them. But that's okay. We don't need to find every single shift in the market, right? We just need to make some money and find some of them. You find a couple, you're golden, you made some money, you go home, you go out to eat, take your wife out on a nice date. Okay, take kids to Chuck E. Cheese and retire early, hopefully. Okay, so I wanted to point that out because I want you to be realistic. There's nothing magical about this. It is not magic. It is just kind of the way that, actually we could get into the whole reason as to actually why this does work, but and we will if we have time, but I don't want to spend time on that right now. I want to make sure we get through our whole presentation here on time. So now the next tool, this one is uber cool. So we talked about Fibonacci tools that measure price levels, the y-axis. Then I just showed you one that measures time, and that is your x-axis. and W.D. Gans saying that trading is all about the confluence of time and price. Now, here's a tool that combines both time and price into one tool. And it can be called Fibonacci circles or Fibonacci arcs. Depends on the charting platform you have. They use different terms. And actually, they're both the same thing. So the truth is that it is drawing a circle, but on your chart, it's probably going to be just visible as an arc. So here's what it looks like. We're going again from an impulse move. All these things start with an impulse move, from that high to that low. All right, just 2-point drawing tool, click, click, and it draws them into the future again. Love these ones that give us ideas into the future. And now notice how this one is not a straight line. Before we had straight horizontal lines or straight vertical lines. Now we have a curved line. And that is what is giving us both time and price, because it curves with time and price as they change. So it is curve, 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 curve. Oh, by the way, so it looks like an arc here, right? If I were to scale this out and look at it, big, 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 big picture, you would actually see it's a 360-degree circle. So that's why they use the different terms. Doesn't really matter. But I will give you one little extra clue here. When you draw these, it is good to pull out and look into the big picture and look in the history, look back, and see if in that 360-degree circle, the high and low that you drew actually proved to find highs and lows in the past. That's one way of determining whether the highs and lows you're using are good ones for the future. So a little advanced tip there. All right, so as you can see, we've got our arc here, and the market goes up, 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 gets right into that, and then bam, that's where it falls. And so this is really the best tool for confluence of time and price in one tool. Two in one. Notice again, being realistic, does not capture that low. Oh well, so what? All we're here to do, we're not here to predict everything the market's going to do. We're here to make some money, honey. And it marks this one, and it finds that one. Cool. I'll make money there. I'll make money there. Let somebody else have that money. That's okay. I don't need all the money in the world. Somebody else needs to make some money too. All right, so again, it drew that out into the future. So, love that tool. That's a really cool one. Check that one out. Oh, by the way, let me say one more thing about this. This is really important. It's not really an advanced, it's kind of advanced, but it's not really advanced. It's just one that most people don't know. But if you don't know this, you will be totally screwed up. And that is this. When you use a timing tool, whether it's the last one I showed you or especially this one, you have to have a set scale to your charts. In other words, in NinjaTrader, for example, which is this, what you do is you go in here and you just left click and you pull it down a little bit. In other words, you don't want the scale of the price axis to change as price continues to move out into the future. If it does, these lines, these arcs, will move. They will move. So you can't, then you're messed up. Okay, so you've got to have a fixed scale. Again, talk to your charting platform support team and just ask them, how do I fix the scale so it's not dynamic, so it's not changing as price continues to move. And the reason it'll move is even not so much on the future, it can do that, but even on the past. If you've got a high or low that goes off the top or the bottom of the screen, it'll change the scale. And once you got this locked in, you cannot have the scale of the chart change, or these arcs will move and not be accurate anymore. Okay, so now let's get to what I promised. Alrighty, we've got Fibonacci and all these different cool tools that we can use and techniques. But as we saw, Fibonacci and support resistance in general, oh, by the way, let me add this. So support resistance levels, that's what Fibonacci retracements are, extensions are, but Fibonacci timing tools are support resistance as well. Think of them as support resistance time zones. Don't hear about that too often, do you? You hear about support resistance with price levels, the horizontal lines, but yeah, price has support and resistance as well. So think about it that way. All right, now, having said that, let's get back to the point that these levels don't always cause the market to bounce off of them. I showed you how sometimes the market will just slice right through those Fibonacci levels. And I said, okay, so now the pregunta is, hey, how do I know which of these levels are going to hold the market this time? This time meaning when I'm in the trade. So we have to add more stuff. And support resistance, which is the bigger category of Fibonacci, that is one piece of evidence. So we cannot trade it alone. We need other stuff. So here's what I use. I use 5 things, and I'm measuring the energy in the market. And there's actually 5 energies, 5 subsets of the energy. So here they are. I'm just going to give you the list. The first thing I look at is trend, and I use a moving average for that. What's the direction of the market? So we want to trade in the direction of the trend early in a new trend because that is where our best reward to risk ratio is. Number 2, I want to look at the momentum of the market. What is the strength? And strength has to do with the money flow. Is there a lot of volatility? Is there a lot of velocity? A lot of orders coming in quickly. And what are the size of those orders? So not only the size of the volume of the bar, but what are the size of the individual orders? Do we have whales coming in, or do we have a lot of retails coming in? That's very important. That distinction is huge. That creates strength. So I don't want to trade a trend unless it's strong. So make sure before you take a trade, you should always ask yourself, is this a strong trend or a weak trend? If it's a weak trend, I don't care if it's a trend. Stay out. You will be stopped out. Just because you're in a trend does not mean it's going to continue. All trends come to an end someday, right? All good things must come to an end. The trend is your friend until the end. So we all know that stuff. But how do you determine whether the trend's going to end? Well, number 1, you trade early, but sometimes trends are real short. So you got to make sure it's strong. Number 3, cycles. When do you get into that? So again, the x-axis, timing. And so I've got a timing indicator. I'll be happy to make it available to you guys for free, by the way. At the end of this presentation, I'll show you how to get that. And that's very important. Very, very few people have a timing tool on their charts. Well, again, dang, if you don't have a timing tool, you're ignoring 50% of the information on a 2-dimensional chart. Not too helpful for your odds of winning when you're giving up 50% of the information. The 4th is support resistance. Now, this is actually where Fibonacci fits in. So I'm not even looking at my Fibonacci levels in a serious way until I've already determined trend, momentum, and cycles, swing highs and swing lows. Then I say, okay, is that swing high or swing low? First of all, I want to trade in the direction of the trend. So if it's up, I'm only concerned about cycle lows. If the trend is down, I'm only concerned about cycle highs. And then I want to make sure that cycle high or low comes into confluence with a support resistance level, a Fibonacci level. And then these 4 are all on the short-term chart. And then if they're all, say, bullish, then I'll look at the higher time frame. And I'll say, okay, is this in the direction of the dominant energy of the higher time frame? If so, cool, I'll take the trade. If not, let's say these energies on the short-term chart are all bullish, but the dominant energy in the longer time frame is bearish, that is a filter. The longer term chart frame has veto power. And then it says, nope, looks good on the short-term chart, but there's a stronger energy on a longer time frame that is counter to the energy on the short-term time frame, and therefore I won't take the trade. So these are the energies, and when I use the word energy, you can think of it as money flow. The energy of money flow divided into 5 subsets. So we use this to determine a probability scenario, looking for these energies to align. Give each set up a score of 1 to 5 based on the 5 energies. How many are aligned? Obviously, the higher the score, the higher the probability. I kind of liken this to taking a trade to court. I need 5 independent witnesses to establish a preponderance of the evidence. And that's the key. The operative word there is independent. So these 5 energies, the reason I use these 5, and there's more you can use, by the way, there's velocity, there's volatility, and volume, and they're all good stuff. But these 5 are, for me, the ones I use on every single trade. And the reason for that is that these 5 energies are each non-correlated to the other 4. So when you get 5 non-correlated energies all aligning, that's what gives you your probability scenario. So real quick, I'll just show you a little chart of each one real quick and how I use it. So trend, I just use the 50-period simple moving average. I don't really use anything complicated in my trading, so it's all pretty darn simple. So didn't have to hire a NASA scientist to create this for me. It's a common moving average, maybe the most common one. This and the 200 seem to be very, very popular. And it gives me the overall direction of the market. Okay. So many people think, you know, higher highs and higher lows are a trend. That's part of it, but the dictionary definition of trend is this: to extend in a general direction. So really, according to the dictionary, a trend is a long-term move, not a short-term move. So this right here, that's, yeah, we got a little higher low, or a lower low, lower high. That's just a little complex retrace in an overall uptrend. And it's not just that we want to, you know, be great English students, but it has financial ramifications, obviously. We want a big reward, and we want to keep our losses small. So trading in the direction of the long-term direction of the market gives us a good reward to risk ratio. Now, the energy of momentum, again, refers to the strength of the market. So we've got higher high, higher low, higher high, higher low, higher high, but look at our momentum indicator. Here, higher high, higher low. Cool. So if I wanted to go along there, I'd say, cool, I can do that. Why? Because it's a strong trend. Higher high on price, ooh, equal high on momentum. Maybe even a little bit of a lower high there. I don't know, it's close. But anyway, it's definitely not a higher high. And so that's my first warning sign. Now, momentum can be a leading indicator. It isn't always. There's no such thing as something that always leads the market. There are just no crystal balls. But I was trained in Chicago at the Chicago Mercantile Exchange. So I've been on the floor and I've seen it, and I'll tell you what you experience there is a very visceral experience. Well, back then anyway, most of the pits are closed now. But it was a very good way to learn how to trade, because you can actually see, okay, who's coming into the pit? Is it just all the guys who are tending bar at night and they're trying to become floor traders, or is it Merrill Lynch, Goldman Sachs, and Citibank? Okay, also, what are the velocity of the orders? Is everybody in the pit screaming, yelling, getting in as many orders as they can, trying to get them in before everybody else? And are those big orders, or are they just people throwing in their, you know, little one lots? So that made a big difference. Also, volume. The volume took on a double meaning on the exchange. So volume, yes, it's the size of the orders, but also it's just the auditory volume. You could stand there, and it was almost like an indicator of how loud the room was. If everybody's yelling and screaming and pushing and shoving, that was by another indicator. The brokers had actually hire professional football players or ex-professional football players just because of their physical prowess and height, because, well, that's how the game worked back then. Anyway, point is, you could see the momentum. You could feel the momentum there. So on charts, we just graph it, and it's actually less violent. So we see the momentum starting to come out here, but again, yeah, market makes a higher high. Market still makes a higher high, but momentum's coming out. This is why I say momentum can be a leading indicator. The market can continue to go up. There can be some retail buying, some amateur buying, but the pros, they're done. They're done. And so the velocity is starting to slow down in the exchanges. The room's starting to get a little bit quieter. You know, the big guys are starting to leave the pit, or they're just not ordering as much. Anyway, we see it here on the graph. So, yep, price made a higher high. Momentum made a lower high. Now, a lot of people look at these for divergences, and that's cool. But look at the low. Look at the low as well. Higher low on price, much lower low on momentum. You want to look at both, not just the highs. Look at the lows for these kind of patterns as well. Very important. So this is just another example of how you can look at that. So we'll just go through that one real quick. All right, energy number 3. Now we come to cycles. Cycles are like the rhythm of the market. I think of them as the respiration, actually. The inhale, the exhale. The inhale, the exhale. It's almost like if you're lifting weights. You know, when you pull the weight down, let's say you're doing a bench press, you inhale, and then when you push the weight up, whew, you exhale. And that's how markets move. So exhale, whoosh. Inhale, get ready for the next move. Exhale, whoosh. Inhale, get ready for the next move. Whoosh. And so this is part of my cycle indicator. It's a simplified version of it. Again, I'll make that available to you here in about 5 minutos. And see, this rhythm of the market gives us great times to enter. And it's especially important because if you can time the market well, then it helps you avoid getting stopped out. We want to get the final cycle high, the final cycle low. Support resistance, we talked about this with Fibonacci already. Again, but I'm just going to put it all together for you now. So here's our impulse move. Here's our Fibonacci retracements. Here's a level. We'll just talk about this one today since there's only about 4 minutes left. And we're looking for the confluence of the energies. So we've got a cluster this high and the 50 Fibonacci. There's our cluster. Cool. So that's a stronger resistance level. We've got a 2-bar reversal pattern on candlestick. Notice that the 50 MA is angling down. That's our trend indicator. This is actually a structure I call the rubber band trade. Price above a downward angling 50 MA. And I'm going to give you that trade set up for free today. So we'll give that to you in about 3 minutes. And we got a cycle high, and momentum is very low. Notice when the market went down, momentum was strong to the downside. Then at this lower low on price, momentum was still kind of strong, but not as strong as here. There's your momentum shift. Notice the high here is higher than the high here. See, notice the same pattern there. Shift on both highs and lows. Then when the market does go up, it goes up on very little momentum. See, there's your zero line. Very little strength. So it's not going to be sustainable. And when the market goes into resistance, if it's going to bounce off, we want it to see it on weakness. And that's exactly what you've got there, and it resumes its way back down. And energy number 5 is the next higher time frame. So here we've got a 2-minute chart on the left, 6-minute chart on the right. I kind of like a 3-to-1 ratio or 1-to-3 ratio. You can do other ratios if you like. But the main point is here we have a beautiful little first retrace in the trend pattern. Trend is down. We're holding the 15 EMA. That's the 50 EMA. That's the 15 EMA. There's our cycle indicator. Boom. Time to go short. Momentum below 0. We don't want a strong, if we're going to go short, we don't want a lot of strong buying coming in. We, again, want the strong exhale and then just a little inhale. We don't want a bunch of smart money coming in and buying. We just want some profit taking and maybe some retail buying, because we want the dominant energy to remain to the downside, and that indicator tells us, yeah, the momentum is still to the downside. Why? Because it's below 0. If it came up to 0, then there'd be no more bullish or bearish momentum. It would be neutral. If it went above 0, well, then it'd be bullish. That'd be really bad. So that's cool. Now, the fractal energy means we look to the next higher time frame, and we want to trade again in the direction of momentum of the higher time frame. So we want momentum, the strength, to be down on both time frames concurrently. And that's really cool because that gives you a situation where if there's a lot of strength on both time frames in the same direction, then usually the market's going to move pretty fast. It's going to haul, well, it's going to haul butt. I'll just say, okay. So those are the kind of trades that are fun. The market doesn't just, go down a little bit and then hang around and you get frustrated. You feel like, come on, move, move, move. Now, this is how you avoid that problem. And we all like to see our P&L move fast. So that's one way to help that happen. So this 5 energy method is what I call it. It works for pretty much any market and time frame. I trade it on stocks, commodities, options, currencies, futures, and I do it for day trading, swing trading, investing. It's simple. We're counting to 5, and of course you have to include a complete trading plan, psychology of trading, and risk management, money management, all of that. But as far as the technical aspect goes, there's just these 5 things. I've come full circle over 50 years. I've started simple, lost money, got really complicated, made some money, then returned back to simplicity, and make more money now than ever. So what I've got for you today is, unfortunately, I dropped the ball a little bit in the sense that I don't have anything to sell. I should have come with something to sell today, and I didn't. So, yeah, I apologize. I know you guys are all bummed out and like, wait, man, the whole reason I came here was to buy something from Barry. Well, you can't. So, but I will give you something for free. I'll give you one of my courses for free. This course is called Make Money by Breaking Every Trading Rule You Ever Learned, and it talks about how traditional technical analysis is wonderful, but things have changed a lot since the 1940s when the Bible of Technical Analysis was written. So this is an update on how to trade markets today with high-frequency trading, algo trading, all this kind of stuff, lowering of commission rates, penny spreads, all that kind of stuff has changed trading dramatically and changed the way the charts look. So anyway, this addresses that. It comes with 5 20-minute video tutorials. After each one is an interactive quiz. As I mentioned in passing, I'm going to give you one of my free trade strategies, so you're not only going to get ideas and theories, I'm going to actually give you a trade strategy you can actually pick up and trade. Obviously, you should trade it with a simulator or demo account first. It's called the rubber band trade. It's going to give you all the rules for entries, exits, stops, all that stuff. And take it with my blessing, and I hope you make a lot of money with it. And then, as I mentioned, my cycle indicator. I'm doing I do a webinar about once or twice a week where I give away my cycle indicator and I teach you how to trade it, because the indicator itself is not really obvious how to trade it. But this is what actually gives you the signals for when to enter a trade. And I give that all away for free. Works on any charting platform actually. And I give you the indicator, give you the tutorial, no charge. So you can get all this stuff at one place. And there it is. Bit.ly, well, yes, bit.ly/Traders Talk Live. And if you go there, you will be able to get everything, all of it, for free right now. You get access to the very first lesson today. So that's it. I think, oh, dang it, I went over 2 minutes. Sorry about that. Anyway, thank you to my friends at Traders Talk Live. Thank you to everybody who came here today. Appreciate you guys, and have a great rest of the day.